And now let's talk about precious metals. By the way, this video is a continuation of the previous one talking about the US dollar. If you haven't seen that video, check it out first. That's the US dollar value video from today, 18th of January 2021. As I mentioned in the video about the US dollar, there is possibly around 40% chance dollar just drops from where it is right now. Another 40% chance that it continues a little bit higher just for another few days before it turns around and drops down into the end of its intermediate cycle low. And possibly only about 20% chance that the dollar just keeps pushing higher from here, having seen an intermediate cycle low in early January, and just continues into the rallying stage of the new intermediate cycle. So with that in mind, I think there is only around, say, 20% chance that gold continues to suffer for the next several weeks as dollar just keeps strengthening. This scenario is not very likely in my opinion. What's more likely with probably more or less equal probability is that gold either continues higher from here into the second daily cycle of an ongoing new intermediate cycle, or gold continues lower for another few days before starting that second daily cycle. Talking about these daily cycles, now that gold has created a new low compared to last week, there is a pretty good chance that this is the low of the ongoing daily cycle, which would give us a cycle that lasted for 49 days, which is very close to an average duration, anywhere between 1.5 months to 2 months. At today's low, we also have seen a bit of a poke through the lower range of the Bollinger Bands, and as I've mentioned in a lot of my previous posts, a repeated poke through the lower range of the Bollinger Bands, especially when Bollinger Bands are not very narrow, is often followed by some sort of a rally. Additionally, for now, today, before the US markets open, we see a relatively big green candle on gold, but to be honest, on Monday morning for the US, once the markets open, I do expect a bit of a cool-off in gold price. Perhaps, so far, we see this big green candle because, well, maybe the Asian markets are a little bit less bearish generally on gold compared to their Western counterparts. Looking at the 14-day RSI, although it hasn't dipped into the oversold levels, I think it's come deep enough for the end of the daily cycle rather than the end of an intermediate cycle. As we see over here at the very end of November, at the intermediate cycle low, the 14-day RSI did come down into the oversold level. And it possibly came low enough yesterday to under 39. So either today or sometime this week, I would really expect gold to start moving higher into the second daily cycle of this relatively young intermediate cycle. Another positive sign for precious metals in general is silver. This is a daily chart of silver, and we see that silver is above both its 200-day and the 50-day moving averages, whereas gold is actually below both of those averages. Silver outperforming gold is, I think, a positive sign, especially since usually at the beginning of an intermediate cycle, silver is lagging gold, and it's only later in an intermediate cycle when silver usually overtakes gold. Perhaps one hint from this outperformance of silver early in this intermediate cycle is that, well, maybe for the ongoing intermediate cycle, you possibly want to have a slightly larger allocation to silver-related assets rather than gold-related assets. Next, moving on to our 25-week return on gold. First, let's review the history. This is how this 25-week return performed in 2013 to 2017. The blue line here is gold price, red line is the rolling 25-week return on gold. If you haven't seen this in some of my previous videos, the idea with this indicator is that 25 weeks is close enough to an average duration of an intermediate cycle in gold, and as gold price drops into its intermediate cycle low, the dips in this 25-week return might help you to find a good buying opportunity. The black circles over here show these dips in the 25-week return that more or less coincide with the intermediate cycle lows in gold price. The way I see this chart is that Generally, on average, these black circles takes place somewhere around -8%, say -10% on the 25-week return. So whenever I see this 25-week return anywhere between -5 to -12%, I am getting quite interested in catching a buying opportunity in gold and catching that intermediate cycle low. Next, let's have a look at 2018 to present time. We only see a few intermediate cycle lows in this time frame, and those coincide with the 25-week return dipping down to -11%, +4%, +5%, 0%. And the last time we talked about this 25-week return, we were somewhere around +5%. That dip to +5% came close enough to that intermediate cycle low at the very end of November. But since then, this indicator has actually improved quite a lot, dropping down to -8% or so, which tells me that we are pretty close to an intermediate cycle low. And this indicator doesn't perfectly match those intermediate cycle lows. Over here, for example, at the end of 2019, the red line found its low a little bit later than the gold price, the blue line. Sometimes the opposite happens, as in here, for example, at the end of 2015, the 25-week return bottomed a little bit earlier than the intermediate cycle low took place. So it's not a perfect timing indicator, but nevertheless it can be helpful to identify general time frame for your buying opportunity. And as gold is close enough to giving us something like a double bottom for this intermediate cycle, this 25-week return first drew our attention by dropping from nearly 30% down to only +5%, which was already somewhat interesting, and it's now flashing even brighter at -8%. Next, moving on to market sentiments. This is optimism index on gold. We see that the recent intermediate cycle low took place when this optimism was at about 51, and the recent drop brought this optimism down to 54 as it closed on Friday. So even if gold continues lower for another few days, we are not that far from a nice buying opportunity. Because as you see over the last couple of years, a buying opportunity came whenever this optimism index was somewhere around the level of 50. Remember, you want to buy when everybody is pessimistic, and whenever everybody is very optimistic about something, such as here in August of 2020, that's when you want to sell. That would align with some sort of a local top. However, a word of caution over here, if you look at history beyond the last couple of years, usually the intermediate cycle lows on gold took place when this optimism index came as low as 30 rather than 50. And that actually matches with our 20% scenario, relatively less likely scenario where dollar just continues moving higher into its ongoing new intermediate cycle, in which case possibly this intermediate cycle for gold will be somewhat broken and we'll see gold going down below 1800, where optimism index will possibly come much closer to 30 as it did many times before 2020. But as I mentioned, I don't think this is a very likely scenario. Next, let's have a look at the optimism index on gold miners, on GDX. This index is a little bit more volatile, as you see just here since March 2020. This index has already poked below this green line at 20 multiple times, so I like to look at this 10-day moving average of the optimism index, and it has dropped recently, giving us another buying opportunity on gold miners. And if the trend continues down for another few days, as I mentioned, possibly gold and miners might give us some sort of a double bottom formation for the end of this intermediate cycle. And lastly, having mentioned the possibility of a broken intermediate cycle over here in gold, where there is a risk of gold dropping down below 1800 and even below the previous intermediate cycle low at around 1760, let's revisit our long-term expectations for gold. Even if this ongoing intermediate cycle ends up a huge disappointment, and to repeat, I don't think this is a likely scenario. How about our long-term bullish expectations for gold? Let's compare the drop that we've seen over the last several months in gold versus the drops that gold experienced in its recent bull markets so far. The previous drop over here in March was around 15%, similar to what gold experienced over here between August and November, around 15% in both cases. The previous relatively severe drop was around 15% again in this very long intermediate cycle decline, which I remember was quite exhausting. Another severe drop before that was in 2016, just after the presidential elections, where we saw a drop of around 18%. For earlier drops, we're going to move to the previous bull market, which started in early 2000s. Let's have a look first at this early 2010, late 2009, where gold dropped by around 15% in that intermediate cycle decline. Before that, in early 2009, another considerable drop of around 14%, which came after a very painful drop in mid-2008 of 31% down, which itself came after this relatively painful drop of 18% down, which gave you this inverse head and shoulders formation for gold, followed by the continuation of that bull market where gold price just doubled from this inverse head and shoulders. Continuing to move back in that bull market in gold, in the first half of 2006, we see another painful drop of nearly 26% on gold price. And lastly, another couple of significant drops of 12% in early 2004 and 13% in early 2003. So what I'm saying here is that even after this significant drop of 15% between August and November, and even if this new intermediate cycle does turn out to be a disappointment, I would still remain bullish on precious metals in the long term over the next several years. But of course, you'd have to be a little bit careful in your trades, trying to avoid being dragged down into those intermediate cycle lows. Talking about trades, let's see how this green candle behaves as the US markets open. If I don't see too much damage to this candle, or if whatever damage happens in the morning is repaired a little bit later, I might re-enter into those GDX and GDXJ positions. Although, on the other hand, as some of the members pointed out, my fictitious portfolio is already a little bit too heavy into precious metals as opposed to other types of assets such as energy and the general stock market. I might have to think hard again about those allocations. For now, I wish you a wonderful day and good luck in your trades.